All right, hello everyone, and welcome to what will probably be the final VCE Economics exam prep video, where we're going to be looking at key data you should know, aka all the key figures for the economic goals and some other things, along with some final facts or important things that you should know at the very end, and some AD and AS policies that I think are very, very easy to use in your exam responses if you want to sound super smart and get as many marks as possible. All right, let's get straight into it. So we're going to be looking at the data you should know. So hopefully all year you've been using current data. In VCE Economics, you need to know recent figures being the last 2 years. And what tends to be really important is knowing where they are now, which direction they've been trending. So attempting to know data for the following key indicators can really make your answers stronger. And a tip that I like to use is that if you are using data, quote the month that data is from, because it's going to mean they can't really take marks away from you if it's not the most current data. You're saying, based on what I know from this day, these are the facts and figures. So the key indicators that you should know are the 3 government goals: economic growth, inflation, and unemployment. We're going to look at them following on from this regardless. The cash rate, which hopefully you know really well, seeing it's been a big deal in the last week. The exchange rate, which fluctuates, so just knowing around where it is and the impacts of that. And the budget deficit, which hopefully you also know the budget deficit of the last 2 years. We're going to talk about that. It's not just important to know the data, but also which direction it's trending, as that can help guide your application in your answers. So knowing that if consumer confidence starts to rise, the impacts of that, people are going to start to spend more, which can help increase consumption spending, increase aggregate demand, lead to increases in all the economic goals. So let's get into some of these key important figures, and then we'll carry on from there. So first up, economic growth. As of June 2020, economic growth is, if we look at it, has massively, if we look at it as a trend, has been on a declining trend, and we have it at negative 6.3% GDP growth as of June 2020. Obviously, that's massively due to the coronavirus, lockdowns, etc. For your explanation of that, but negative 6.3% is going to be a big, important thing to talk about. So our economy shrunk by 6.3%. We produced 6.3% less things. A random other economic growth tip, or anything that's growth, say for example over here, how we have 1.6% growth in the March quarter, and it went down from 2.3%. That doesn't mean we produced less. That means we only produced 1.6% more than the previous period. So important thing to know, growth means you are hopefully increasing, except when it's negative, which means you are shrinking. So trending downwards for economic growth of 6.3%, which is current as of June 2020. Our inflation rate. So inflation rate as of September 2020 has picked up a little bit to 0.7%. As a lot of Australia has begun to go through the economic recovery post-coronavirus. You'd expect that going into the December quarter, it'll pick up more based on restrictions easing and increase in retail sales. But some of the really important things, like inflation, is an interesting thing to look at this year. In the March quarter, it was 2.2%, and that was largely due to panic spending, panic buying, driving prices up on a lot of fresh fruit and vegetables, etc. And then we had deflation in the June figures that came out of negative 0.3%. So it's kind of hard to talk about inflation and the fact that it has been decreasing. If you were going to talk about the trend in inflation, you'd say that it has been low. It's been low for a fairly long time now, but it increased due to the impacts of panic buying, and then we experienced some deflation following up with a slight increase to 0.7% in the September quarter of 2020. And that can be due to increased levels of aggregate demand and all of those kind of things. Now, the unemployment rate. The unemployment rate is an interesting one. I've got some facts on it a little bit later on, but obviously due to the pandemic, we have had a significant increase in unemployment. We're right around the goal for a long time, just above 5%. And then we faced this big increase, peaking at 7.5%, much less than they're expecting. They're expecting unemployment to go up as high as, well, some predictions went up as high as 15%, but around 10%. Then the RBA went back on that, partly because JobKeeper, etc., kept people technically employed. and now we're sitting at around 6.9% unemployment. So it has increased over time, but is not as significantly as they're expecting. A lot of policies that have been put in place haven't been to stimulate jobs, they've kind of just been to slow down the loss of jobs or keep people in jobs. And we'll talk about that more when we talk about the cash rate. But unemployment at 6.9% as of September 2020. One reason that we'll get into talk about later slightly for this is that the labour force participation rate has actually decreased a little bit and the unemployment rate has increased. So that can overstate the figure pretty significantly. The cash rate. If you do not know that the cash rate decreased to 0.1% last week, you should know that. And we did a whole video about that. So if you want to know more about that, go to that. But the cash rate being 0.1%, the RBA has kind of acknowledged that they're not expecting much of a difference to be made through the RBA decreasing the cash rate of the interest rates. There has been some flow-on effect through fixed rate interest rates being decreased in most banks, meaning that households have better cash flow, which lead to increased consumption spending, investment spending by businesses. That will be some effect on aggregate demand to increase it overall, but a large part of decreasing the cash rate was to hopefully depreciate our exchange rate, because when the cash rate's lower here, foreign investors will remove their investments in Australia to seek better returns elsewhere. This creates an oversupply of Australian dollars on the foreign exchange market and depreciates our currency. And then when our currency is depreciated, it makes our exports more attractive, which can then help increase aggregate demand, create jobs, sustain employment, and help out achieving employment that way. So the RBA isn't too worried about inflation. Normally they fight inflation first. At the moment, they're targeting growth in jobs. So cash rate, 0.1% as of November 2020. Exchange rate, sitting between 72 and 73 US cents. I said before about them wanting the cash rate to depreciate the Australian dollar. Hasn't really happened. Stayed around the same rate. We'll keep an eye on it. But talking about being at that rate, our exports are pretty strong at the moment, but really we want the AUD to depreciate more. They kind of want it to be under that 70-cent range. If the Australian dollar depreciates, that's going to be great for our exports, which is great for eco growth and full employment. 2020-21 budget deficit. So expansionary stance. I say this just because there's a lot of questions where it says explain or outline the stance taken by the federal government in their budgetary policy. Expansionary stance, very important to say. That's probably where some of your marks are going to come from. But it is a $213.7 billion deficit. It's good to be able to drop that figure. Technically, as long as you know that it's an expansionary deficit and it's the largest deficit in recorded history, probably going to be all right. But if you can say that number, you're going to look very, very smart and then be able to give some of the reasons for it, some of the things they're doing to try and stimulate the economy. Now, to move on to the second part of this video, we're going to look at some easy aggregate demand side policies. So one of my favorite ones to go with is decreasing company tax rate to 26%. This means that businesses are likely to conduct more private investment spending to invest and expand, and therefore increase aggregate demand. And then that has flow-on effects to the macroeconomic goals. The job seeker welfare payments have doubled their value. Well, they've decreased since then, but originally they were doubled, leading to greater levels of private consumption spending, therefore greater aggregate demand. Decreasing personal income tax rates at all income levels should hopefully lead to greater levels of private consumption spending, therefore greater aggregate demand, and the flow on to the goals. And then also, you can use infrastructure projects as AD side when talking specifically about government spending. So this represents an increase in government capital spending, which is an injection to aggregate demand, which then increases aggregate demand. So these are some really easy, simple ones that you can use from recent budgets that will hopefully help you out on the exam. Then some aggregate supply side. Aggregate supply is a bit broader this year because they cut a bunch out of it. I feel like it's more likely that they're going to ask specific questions about subsidies, research, development, education, training, and infrastructure. So let's look at them all individually. So subsidies, the JobKeeper wage subsidy, it decreases businesses' cost of production, which then motivates firms to continue production and maintain overall aggregate supply. Research and development, we've got a 43.5% tax offset for businesses conducting R&D with a turnover under 20 million. The reason for this Its businesses wouldn't conduct research and development otherwise because there's no guarantee it will have a positive impact for them. So this decreases the cost of production for businesses who conduct R&D. And if the R&D is successful, this can increase the efficiency and productive capacity of the business and therefore increase aggregate supply. With education and training, we've got the job creator package. You'd also look at the job maker package, but it's focusing on upskilling unemployed workers in areas of skill shortage in Australia to make labour more efficient. This leads to increased productive capacity, therefore increased aggregate supply. Then infrastructure, 6.7 billion spent on the West Gate Tunnel. In the short term, creates jobs, increases overall production, therefore increased aggregate supply. In the long term, increases efficiency, decreases cost of production through decreased travel times for businesses, which increases our productive capacity and aggregate supply. In infrastructure questions, you sometimes get like a discuss or an analyze question worth 4 marks. Really worth looking at the short-term and long-term impacts to get those 4 marks. And lastly, some random other good facts to know. So our current account is currently in surplus thanks to strong export prices and trade increasing our net good credits and the balance of payments. Consumer and business confidence are beginning to rise across Australia after being really low during the year. An example being South Australia's business confidence went up by like 40-something%, I believe. Job seeker is an AD side policy and job keeper is an AS side policy. Simple as that. People get that wrong all the time. Although unemployment has fallen slightly, the labour force participation rate has also fallen and underemployment has risen, which can overstate those figures. And then lastly, when a 90% effective vaccine to coronavirus was announced yesterday, stocks in Zoom, Netflix, and other streaming services all plummeted. It's not really relevant to your economics this year overall. It's kind of interesting to economics in general, because all of a sudden when people weren't going to be working from home, all the things they use when they work from home lowered in value. This is essentially most of the really current useful data you need to know for your exam. If anything changes between now and the exam next week, well, that's on you to find out, because I've tried my best to help you out as much as I can. If there's any other way that I can help you though, feel free to let me know. I have a pretty light on load at work at the moment, so I'm more than happy to help out. It's a good time of year for it. There's only 13 days until the economics exam. You've probably got a billion other Year 12 exams between now and then, but hopefully you are feeling prepared and confident for it. On that's essentially it. Hope you have a wonderful day, and I will talk to you hopefully soon. Bye.